In this video, I'm going to share with you guys, per usual, housing market updates, the Federal Reserve, and why I ultimately believe inflation doesn't mean jack Hey, what's going on, guys? This is Daniel, one half of the Kwok Brothers. And in this video, we're going to talk about the Federal Reserve, inflation, and of course, housing market updates. But before we go ahead and do that, I want to talk to you guys a little bit about Citadel. Now, I've been plugging Citadel the last 2-3 videos in the housing market series. Now, again, guys, it's a reminder. If you don't know what it is, it's an organization started by my good friend Andy and my good friend Mackenzie. And they're bringing entrepreneurs, business leaders, and influential leaders from all across the world, all in the name of just doing good and solving the world's biggest problems. So our goal is to raise $60,000. That's all they need for them to get their initiatives started this year. So I hope you guys would join me. And of course, I'm happy to announce that Sam and myself, we're gonna be matching up to $10,000 in donations, guys. So the link is in the description below, and I cannot be more excited to partner with them and help them out and walk alongside them in doing that. So I hope you guys and pray would join me in doing so. All right, so let's go ahead and get down to business. I'm gonna read you guys some headlines, my thoughts and details, and ultimately why I don't believe inflation is all that as is propped up to be. So first headline, of course, is that Donald Trump and the Trump administration has announced an eviction moratorium happening until the end of the year. Now, guys, I want to specify the details. This eviction moratorium applies only to individuals making $99,000 or less, which, by the way, guys, according to different studies, depending on what you're looking at, is 75% to 80% of all of Americans. Now, of course, guys, this is going to put a lot of stress on us as the landlords, especially if we have a big debt service, especially if we have a big portfolio. Maybe we over leverage a little too much. Now, I know there's a lot of talks, there's a lot of different associations and a lot of different councils that are lobbying and pushing for Congress and the presidential administration to push something officially to help out landlords until the same time the eviction moratorium wears off. But of course, we haven't seen a whole lot of things in concrete just yet. Let's move on to the next headline, which is that the single family housing market continues to stay red hot. I mean, my goodness, this is like Klay Thompson in the third quarter of any Warriors game. I mean, this is insane, right? And to give you guys an idea and share some more details, we have home builders out there since 2006, guys. Check this out. Since December of 2006, guys. I mean, that's a 14-year span that we reached in terms of a new record for the highest demand in new construction homes, which obviously falls upon the prices of how much these builders cost to build, the price of supply, you name it, it all trickles down. Now, having said that, we are third consecutive month, guys, including the month of August, which obviously just ended, of continual consecutive growth in the single family housing market. I don't think anybody who would have seen this coming after what happened in March. I think for a lot of us back in March, we all thought this was 2008 all over again. We saw the stock market dip. We saw a lot of things in volatility and danger, right? I know for me, at least, a part of me was like, oh my gosh, this is it. This is what I've been waiting for the last 2-3 years. It's finally happening. But including August, we have 4 consecutive months of growth, which complementing to that, mortgage applications are now up 33%, guys, year over year. So if you're looking at August, July compared to August, July of last year, 2019, we are seeing a 33% increase in mortgage applications. That is just ridiculous, right? And obviously, this also points to a lot of overinflation in the values of stocks, in the values of especially tech companies here in the US, right? I think I read a statistic that the margin, so the market share for US tech companies is actually more in terms of the stock market than the entire European equities market. I mean, that's insane, right? Now, I know a lot of you guys are saying, oh, inflation has a lot to do with that. Let's go ahead and talk about that. Let's go ahead and talk about the Federal Reserve, which, by the way, guys, I believe this week they issued out a new policy with Jerome Powell pretty much talking about having the Federal Reserve keep inflation at an average of 2%. Now, I don't know what you guys have been seeing. I've been seeing a lot of things that point and a lot of conversation happening around the idea of inflation, and people are worried about inflation. Inflation seems to be everything that they're talking about, which, by the way, guys, let me say this, right? I know Jerome Powell, his intentions were to keep interest rates low, and his initiative is to keep the mortgage rates low, right? As my brother Sam would remind you guys, just because the federal lending rate, the interest rate is low, it doesn't always mean 100% of the time that the mortgage rate that you're going to get at your local bank or Fannie Mae is also going to be low, right? There is a spread that the banks make their money on. Okay, so let's go ahead and get back to the topic of inflation. I'm not gonna lie to you guys, my personal belief, whether you agree with me or not, and guys, I'm open to learning. If you guys disagree with me, let me know in the comment section below. So let's talk about inflation, right? Because it seems to be something that everybody is talking about. Now guys, my personal opinion is that inflation doesn't matter as much as we think it is, right? As the mass media thinks of it, right? I'm not saying it's not important, it's still important, but it's not a big deal as everyone thinks. Let me give you guys an example, right? The last 3 to 4 years, really the last 5 years, all people could talk about was the federal interest rate, how it was getting lower and how it was getting higher. There's a gentleman that went on Yahoo Finance who actually said the federal interest rate for the United States is not as important as people think it is. And I actually am referring to a gentleman named Ken Fisher, a gentleman who I actually read multiple of his books, right? He's a phenomenal fund manager. Well, I saw this segment on Yahoo Finance saying that the Federal Reserve interest rate doesn't matter as much because at the time when he was on that segment, which was June 5th, 2019, the federal interest rate was at a range of 2.25% to 2.5%. Meanwhile, the rates in Japan and also the EU were at 0%. And he was speaking about the capital arbitrage model where people would actually borrow money from the EU and Japan banks and actually lend it out in the US and make money on that currency hedge. So in that manner, if you're looking at the whole global supply and demand market, the US federal interest rate did not matter as much. And if we go back to 2008, 2009, and we look at what actually caused harm to the American people, which by the way, guys, if we go back 12 years ago, you're talking about $5 trillion, right? $5 trillion in that market crash. Crash. You get it? Right? So $5 trillion, guys, in 401k savings, pension funds, bonds, savings in real estate values, you name it, $5 trillion was gone from the American people. That's the number, right? Whatever number affects that, that's what I care about. And I'm here to tell you guys that is not inflation. Hey man, Uncle D here, about to get on this private jet. What I want you guys to do, I want you to 10x my like ratio and click like on this video right now and subscribe to the Kwok Brothers, man. We're gonna 10x it. Hit. I'm gonna bring up 2 words, guys. These 2 words have not been uttered in a long time. Lehman Brothers. Now, the reason why I bring up Lehman Brothers is because their leverage ratio was 31, meaning that for every $1 they had in equity, they had $31 in debt. Ultimately, me saying that it's not inflation that allows that $5 trillion worth of savings, bonds, 401k, pension funds to disappear. It's actually over leveraging ratios and also credit and debt crises. And by the way, guys, I'd highly recommend you guys read Ray Dalio's Big Debt Crisis. It's a series of 3 books in which he breaks down the last 100 years of every single recession, every single debt crisis that happened around the world. I had a blast reading it. I was a total geek and nerd when I got it in the mail. I was freaking out, right? I felt like a girl who just met Billie Eilish. It was amazing, right? My wife was making fun of me. It was fantastic. But I highly recommend that you guys read it. You may have to have some prerequisite knowledge. Maybe you got an economics degree to fully grasp and understand. But if you guys want to understand what I'm talking about in terms of credit and debt cycles, that's what I'd recommend. But anyways, let's go back to Lehman Brothers, right? Ultimately, their collapse. $1 in equity for every $31 in debt. Why do I say that? Well, I've got some statistics for you guys, right? Because there's a number called the SLR. That stands for the supplementary leverage ratio. It's ultimately saying how much leverage does a big bank have. Let me read some numbers for you guys. This is the current SLR, the supplementary leverage ratio for the big 3, what I call the big 3 banks in the world. We got JP Morgan and Chase at 6.8%. Let me give you guys some preliminary information. Post 2008, the regulators of big banks actually issued out a requirement of 5% in capital reserves to be able to leverage and lend out. They can't leverage out more than 5% beyond what the capital that they have in their vault, right? The SLR, okay, the SLR, JP Morgan and Chase is at 6.8%, so they're 1.8% higher than that 5% requirement. Morgan Stanley at 7.3%, Goldman Sachs at 6.7%. Now, that's the big 3. Here's what's really interesting. The Federal Reserve actually does their annual stress test. They did this back in June. The GDP, right? This is a scenario, a simulation in which the GDP would contract 8.5% from pre-recession levels. So you're talking about at its height, 8.5% from pre-recession levels, unemployment getting up as high as 10%. The simulation showed that the SLR, again, the supplementary leverage ratio, ultimately which allowed Lehman Brothers to collapse, JP Morgan and Chase would be at 5.1%, Morgan Stanley would be below at 4.5%, and Goldman Sachs would be the worst at 3.5%. Now, guys, I forgot to mention that for current SLRs right now, there's numerous reports and articles saying that the capital that they're using to leverage their debt and leverage their initiatives are actually artificial cash. It's artificial capital, just like in 2008 when the rating agencies gave these big CDOs very false ratings and ultimately led to the demise of the American housing market. Now, guys, I'm here to tell you that we have not yet felt the effects, right? Because right now, I know what you guys are saying, right? Well, Daniel, right, the unemployment went as high as 30%, as high as 40%, depending on what studies you're looking at, right? We've already contracted, right? How come people are not out in the streets, rioting? Oh, actually, that's actually happening. My bad. But why aren't people setting themselves on fire? Why aren't people, jumping from the bridges and things like that? Well, there are a couple things, right? Obviously, we all know there's moratoriums, forbearances, there's record highs. I believe that number was about 700 billion, guys, and I believe 200 billion was mortgage-backed securities. And I know they've added 100 billion each month since then in March, right? And they're up to $1 trillion, guys, since March in terms of the amount that the Federal Reserve has purchased. So that has also in part to do with it. We've got moratoriums, we've got stimulus, we got PPP, we got different programs that has allowed the economy to be propped up again by Mickey Mouse money, right? It's the return of the Mickey Mouse money. So ultimately, what does this mean, right? I'm sure you're asking me, Daniel, what does this all mean for real estate, right? So here's my recommendation for all of you guys that are looking for some type of conclusion in regards to real estate. I'm gonna go back to the 3 strategies that 2 of my friends have mentioned last week: short sales, lease option, owner financing. In terms of what actions that you guys need to be doing right now, I'd recommend get liquid, right? Get as liquid as you possibly can. And number 2, get educated, guys. I cannot stress this enough. Get educated, right? It's a beautiful thing. You know what they say, luck is when preparation meets opportunity, and we're about to get really, really lucky right now, right? So I'd encourage you guys to read the book, right? It's literally free, 0 to 75 units in 1 year. The link is in the description below. It's a free book, 290 pages of how I acquired 75 units in 1 year. So 100%, guys, get educated. I would highly, highly recommend it. And also another thing is find an opportunity that not only survives a recession, but thrives during the recession. The Chinese word for crisis is actually doubled as opportunity. And there's a lot of opportunities that are going to be awaiting, right? I stopped buying multifamily buildings and commercial real estate back in 2017 because I saw what was happening, right? I saw a lot of overinflation in prices, and I saw a lot of things that just weren't setting myself up for success. And I've pretty much been waiting 3 years for that golden opportunity. And I'm fortunate to have my golden opportunity that I'm working on in real estate right now. I'm actually setting up a real estate fund just to take advantage of this opportunity that's actually going to thrive, not just survive right now, and also especially during recessionary times. And also, guys, last but not least, don't forget to like and subscribe to this video. I love to get in touch with you guys. Let me know what your thoughts are on the video. Let me know if you guys have any questions. And don't be a stranger, guys. Feel free to reach out, right? Our email is literally info@thekwakbrothers.com. I'll be sure to include that in the description as well. That's info@thekwakbrothers.com. KWAK is how you spell my last name. So I'd love to hear you guys' thoughts. And I know a lot of you guys watch this video, but I still want to hear what you guys think, and I want to have a conversation. So all right, guys, thank you for watching this video. I'll see you guys in the next one.